We know that the regional banks have problems with their bond positions. And if bond yields keep rising, they keep losing money. That makes them illiquid. And with high rates, there's money moving from deposit accounts in banks that are only paying 0.5% and moving to money market funds that are paying 5%. So they're losing their deposits. What happens to the bond market? So people need to keep an eye on it. The equity market might not like it either. Even the crypto markets may not like it if yields go up.
Former Goldman Sachs executive Raoul Pal delved into the recent economic growth trends and explained his decision to embrace cryptocurrencies. US Treasury yields rose on Friday as traders assessed a slightly higher than expected measure of wholesale inflation. The yield on the benchmark 10-year Treasury note added nearly 8 basis points to 4.16%, while the yield on the 2-year Treasury note ticked up more than 7 basis points to 4.895%. Across Wall Street, there's growing relief that the Federal Reserve at long last may be done raising interest rates. But that doesn't mean turbulence in the bond market will soon become a thing of the past. In a recent interview, Raoul Pal highlighted that if the trajectory of rising bond yields persists, it will have significant implications for banks, causing them to sustain financial losses and face liquidity challenges. Furthermore, he pointed out that even the cryptocurrency markets could be negatively impacted if bond yields experience an increase. The rise in U.S. Treasury yields was propelled by multiple factors, including Fitch's downgrade of the U.S. sovereign rating on August 2nd. Fitch Ratings singled out the cost of higher interest as a factor when it downgraded the U.S. long-term credit rating last week. Fitch says it expects the U.S. deficit to rise to 6.3% of GDP in 2023 from 3.7% in 2022, reflecting cyclically weaker federal revenues, new spending initiatives, and a higher interest burden. Powell's perspective remains steadfast in anticipating a future reversal of circumstances. However, he acknowledges the potential for a temporary surge in bond yields in the meantime. Let's direct our attention to the video.
I've thought bond yields will come lower. And I've spent a long time actually thinking about this. I say that flippantly, but actually I spent a long time thinking about this because all of the business cycle indicators, all of the inflation, forward-looking inflation indicators, all of the unemployment indicators are all suggesting that bond yields should come down and that inflation continues to fall, both at core level and at headline level, and that unemployment continues to slowly grind higher. So why are bonds not suggesting that? You know, while equity markets already started pricing in the fact that there's more liquidity in the system. And I think it's down to supply. I think it's really down to supply because the Treasury has to issue a lot of bonds to finance both the interest payments from the bonds that are coming from maturity, set at higher rates, and the new borrowings that they have. The bond market is already trying to absorb a bunch of this stuff. And there's just not the ability to absorb it all. So supply is pushing yields higher for the time being as the Treasury rebuilds its coffers. The issue is there's about $6 trillion of debt maturing between now and the end of the year. What the Treasury have been doing is issuing short-dated notes generally to finance it. The reason they're doing that is they don't want to lock in 5% rates because before you know it, the budget deficit explodes high.
Right.
So there's a game that I think they're playing here is the Federal Reserve have to, and all the central banks doing the same game, because I think they're all in cohorts, part of this everything code theory. They are going to try and hold this rates up as long as possible to make sure inflation undershoots. Because when it undershoots, they have the cover to cut rates back down to trend rate of GDP growth, which is like 1.75%. So I think the narrative will break by Q4 when we'll start to see the Fed cutting aggressively. In the meantime, do yields go higher? I don't know. I'm watching them closely. There's a risk that they do, and I'm stuck in a bond trade that's losing money. I've had a great year on technology and crypto, and having a offset some of that in bonds. So I still think bond yields end lower, but there is a risk that they lose control here because of the supply side, and there's not enough liquidity in the bond market right now. And therefore, I think that increases the chance of some yield curve control, whether it's like an intervention in the bond market. And we've seen that in the past. It's not uncommon for the US to do. Japan obviously does it. The UK did it recently as well. So listen, I think this turns around, but could it squeeze higher first yields? For sure.
A storm of public and private debt is brewing in the U.S., and the troubles are already beginning to show on the surface as loans pile up and borrower confidence falters. Private debt levels are building fast and hit new records this year. Credit card debt just passed $1 trillion for the first time ever, according to Federal Reserve data. Raoul Pal highlighted that the central problem lies in the substantial debt burden, worsened by an inability to generate ample revenue due to economic slowdown and demographic changes. He noted that alternative measures, such as expanding central bank balance sheets, have the potential to reshape the financial landscape. Pal says that Solana, which is his second biggest crypto portfolio allocation, is most likely about to repeat Ethereum's dramatic recovery from a bear market to new highs just years ago. Solana saw a large influx of buyers over the past 5 days. The price was at $22.6 on August 7th and saw a rally, trading at $24.8 at press time. The price action showed that further gains were likely, although a significant obstacle sat in the $25.5 to $25.7 area.
At first principles, there's too much debt. And we can't manage it, and we don't have the money to pay for the interest, let alone actually pay off any of the debt. And that's the dirty truth. And we don't raise enough taxes because economic growth is trending lower over time due to demographics. So you don't have the money to pay the interest. You can't pay off the debt. So you're in this trap where you have to, everything is about managing the debt.
Right.
And from 2008 onwards, the number of these ridiculous parts of the plumbing system that got invented to stop that bit broke, and then that bit broke, and that bit broke. It's because the whole bloody thing is broken and we're just trying to tape it up. Which is why, in the end, I saw this coming back from 2008, 2012, is why I got into crypto. I got into crypto for this. You could see that the end game of the debt, and in fact, I've done some videos called the end game, make it impossible to deal with. Now, most people think there's a debt default. I don't think there is a debt default. I just think that the use of central bank balance sheet goes exponential, which increases the cost of assets, but nobody's wages go up. It's like a mutualization of these interest payments across the general population without raising taxes. It's the same thing.
What does Raoul think is the next catalyst for Bitcoin?
I don't know when the BlackRock ETF comes. I mean, it's just a ludicrous waste of everybody's energy. This, the slowness of the SEC in approving stuff. But we'll look back in a year's time. And it won't matter what date it was. The next catalyst of Bitcoin could be anything. I have no idea. It could be the Fed cutting rates. It could be the bond market losing control and people wanting that. It could be anything.
Are you still interested in Solana?
Yes, it's still my second largest holding. I really like it. It reminds me a lot of ETH in 2018, 19. I think there's a huge amount of activity. I think Tolly has proven himself to be one of the better leaders and thinkers in this space, kind of in the Vitalik mode. I think that the developer activity is great. I think on-chain activity is great. The innovation is great. So there is a probabilistic outcome that it does well. Doesn't mean I'm right or wrong. But so, yes, I'm still very interested in Solana. And I've also seen what I think is the biggest macro setup of all time, which is the exponential age meets crypto meets quantitative easing. Those are so explosive, and I think it repeats over the next few years, that I want to have all of my excess savings in that, because it's a once-in-a-lifetime opportunity to me.
Treasury yields hit 10-year highs, sounding a note of potential caution for risk markets, cryptocurrencies, but Bitcoin continued to be unstirred by macro events. Bitcoin remains in search of a price catalyst that seems increasingly unlikely to come from outside the industry. Spot Bitcoin ETF approvals and the 2024 Bitcoin halving can't come soon enough for bulls. This concludes our discussion for today. Do share your views in the comments section. If you found this content informative, please give it a big thumbs up and subscribe to our channel for the most up-to-date news and videos. Thanks for joining us.